All right, everybody that's joining us this evening, welcome to the StratiVentures Industry Webinar. We actually have a special guest this evening, Miss Rebeca Ramirez. She's going to be talking to us today about becoming your own banker. And so go ahead, guys, and sit tight as we let people start to come in. Feel free to scan the QR code that's down at the bottom of the screen and get to know more about StratiVentures. And then we'll get started. So everybody just sit back here in just a little bit and we'll get started shortly. So Rebecca, how are you doing this afternoon or this evening?
I'm doing good, thank you. Technical difficulties, but
Yep. So you may want to speak up a little bit because it comes through a little faint. But
how is it now?
Perfect.
Great.
Perfect.
I'll keep it at this level.
Okay. Let's see here. Perfect. Here we go.
Thank you, Diego.
You're very welcome. All right, everybody that's joining us this evening, thank you so much for joining us. We are going to get started here in just a second with our industry webinar. Okay, for everybody that's joining us, Oriana is our moderator for SVI, and she's going to be basically sending out some messages via chat in which you guys can read them and hopefully, get some good information from that. All right, 6:33. Let's see where we're at. Wow, we got some good participants here that are coming in. We're seeing a good volume of them. If you guys want to share where you're attending, feel free to put that in the chat box. We usually get people from around the country. And I think, Rebecca, what you do obviously is something that can be done at a national level. Am I correct to say that?
Yes, that's correct.
All right, Reginald, Charlottesville, Virginia. Good to hear from you, Reggie. All right, so it's 6:34 and we'll get started here in just one quick moment. Okay, and everybody remember this is being recorded and then the recording is going to go on the StratiVentures YouTube page. So just simply type in StratiVentures and then you'll go to the video library and there's all the other webinars that we've done, which definitely can, there's a lot of good content there. All right, so let's get this ball rolling here. So everybody, welcome to the StratiVentures Industry Webinar. Today, we're gonna be talking about becoming your own banker with Vigilante Financial Services, Ms. Rebeca Ramirez. Right now, what we're doing is we're basically waiting for people to come in and get settled in. We'll start our main topic here in just about 1 minute. And then at 7:10 approximately, we'll go into attendee Q&A session. So write down your questions or feel free to put them in the Q&A section. For via Zoom, you're gonna have a Q&A section where we want you to put all the questions. If you put the questions in the chat, they're probably not gonna get answered, guys, and we're gonna request that you go ahead and retype those into the Q&A portion. We don't have any polls this time around. If you do have a comment or a topic or something and you need to chat with Oriana, just go to the chat box. And then if you happen to want to leave the webinar, we hope to see you next time, but go ahead and hit the end button. And guys, we do encourage questions because this is 100% for you. StratiVentures is a full service real estate investment company. We have been investing since May of 2012. And we carry the 4 prongs of success, what we believe every real estate investment company should have, which is acquisition analysis, real estate services, project management and contracting, and last but not least, funding. So for those of you that are new investors or seasoned investors that want to get to know us more, reach out to us. Go to StratiVentures.com or info@StratiVentures.com. Send us a message and we'll be happy to contact you and work with you. Here are the key partners and people that work at SVI. The young lady who is the moderator is here, Miss Oriana Ovalles. And I want to personally congratulate her and her husband, Pedro, for having their first baby. She's on maternity leave, and I'm so happy she's here because the last webinar I did on my own, it was a little chaos. And so, Oriana, you're a breath of fresh air, and welcome again, and congratulations to that new family member. Maria Rodriguez, Selections and Design Director. Pedro's our National Sales Director. Eric Christie, he is the resident inspector. He's not an employee of StratiVentures. He actually does that on his own time because he wants to bring value to the investor community that we have. And Stacy Ford is our Real Estate Services Director for our members. And then we work with Ron Dancy as an independent architect, designer, and draftsman. A little bit about myself. I was born in Colombia, South America. At the age of 4, moved to the US. Been in the financial spectrum for a long time, from banking to asset management. Started the company in May of 2012. And in 2020, we launched the national platform because COVID caused us to go online. And now we actually have members from around the country. We have a, how would I say this? We have a, best way to explain it is our motto is it's a win-win or we don't do it, which primarily basically sits at the level that if everybody in this transaction is doing a good job and everybody has their fair share, it's always going to be a win-win for the whole team. So with that, I want to turn this over to you. Rebecca, if you want to introduce yourself, we'd be happy to get to know you better. So I'm going to stop the share, and then feel free to go ahead and share your presentation, and we can get you moving.
Okay, thank you. So first of all, I want to say thank you, Diego, for having me and allowing me to do this webinar. And I want to thank all the people that are showing up for the webinar. This is a tool that you can use to actually become your own banker. And we're going to explain how to do this. It will help people get out of debt and also have money to invest wherever they want to, whatever they decide to do. So I founded Vigilante Financial Services in 2020, also with COVID. I left corporate America in 2021, and then I started learning more about the business and financial business. And then I come across this program, which is Becoming Financially Free by Becoming Your Own Banker, which I found to be very interesting. And this program has been around for a few years, about 200 years. And this is how the rich actually leverage money, they keep cash flow, and then also create wealth. So that's what we're going to be talking about tonight. And I want to say thank you again for allowing me to be here. So the program is the money multiplier. That's how this works. And we're going to discover again how millionaires do it, how they leverage money, how they save money, and again create wealth and create legacy for their loved ones. We have the mysteries of money. So we all know the definition of money, which is just a means of exchange, right? And means of exchange is for product or service. That is what money is all about. If we don't have money, we cannot buy product, we cannot buy a house, we cannot do anything with it. So that's how the economy works. Then we have, where's your dollars? Are your dollars worth more now, today, than in the future? And the answer to that is the dollars are worth more today due to inflation. Whatever we can buy today with $1, we're not going to be able to buy in a few years because of inflation that happens every year, right? Inflation goes up, prices goes up, so the value of the dollar goes down. Then you have taxes up or down, and this one, are you going to pay taxes on the seed, or are you going to pay taxes on the harvest? And in reality, what you want to do is pay taxes in the seed because it's going to be less money that you're going to be paying taxes from than if you pay taxes at the harvest, which in this case, you're going to be paying taxes on the money that you didn't pay tax before, and also taxes on the interest that the money, that whatever investment you did is making. So at the end, you're still going to pay taxes, but it's going to be more taxes. So we try to pay taxes at the seed so that we can save money on taxes as well. And then what do you know about your retirement accounts? I mean, hopefully some people have 401ks, they have savings accounts, they have pensions, they invest in stocks, but all of those, they invest in real estate. And from all of those, the ones that I can see that it has more, that is more secure is real estate. Everything else is based on the market, and if the market crashes, your savings account is going, I mean, not the savings accounts, your 401 account is going to go down, your stock money that you have, the stocks that you have in the markets are going to go down, so you're losing money. You need to be aware of what you are getting. If you have a 401k, you need to review it constantly so that you can make changes to it and put it in a safe, put it into an account that it will be safe and you're not losing as much money as that as much money right now when the economy is really bad and it's crashing. And they're saying we're going into a recession. So right now, if you have money that you can put aside and you can save, that would be the moment. This is the moment to do it. So the money method is the machine. We need a machine. We're going to talk about the marathon, and then we're going to talk about the millionaire. So the machine is what we're going to be using to create this program, right? We're going to be using a whole life insurance policy that is from a mutual company. And the reason why it has to be from a mutual company, it is because it has to give you, the mutual company pays you guaranteed interest, and they also pay you dividends at the end of the year. So if you have a whole life insurance policy somewhere else, it's just a regular whole life insurance, you may get guaranteed interest, but you're not getting any dividends. So it's not helping you to create the cash that you will need, accumulation of cash that you will need to be able to save more money and to use it. And we're going to show you how you're going to be able to use it. So at the end of the year, the mutual companies would pay dividends once they pay all the debt benefits. They pay all the operating expenses. Everything, once they pay everything, whatever is left, they will give it back to the owners of policies that is specifically for being your own banker. They will give it back to you, and it starts accumulating interest plus interest. So what you're getting is a compound interest into your life insurance policy. So that's how you can grow your money, and that's how you can start making more money. So in this case, Bank of America, Wells Fargo, all these big banks have also, they have bought a life insurance policies themselves. They have 75 billion, and I'm sure right now it's more, on policies. They have bought this kind of policies so they can pay, they can pay bonuses, they can pay executive salaries, they can invest in real estate, offices, buildings, and things like that. So they use it themselves. And what do they know that we don't, right? We know that this has been in place for 200 years. And for reality, it was used just by people that really had money. It was not offered to the regular people like you and me, and we were not able to accumulate money as the way they were doing it themselves. So insurance company has made this more affordable for people like you and me to be able to save that money and accumulate cash and create wealth as well. So this is how the banks do it. So let's say that you have $100,000 on the deposit. You're going to put it in the bank. You have a savings. And here is an example. I'm saying it's 4% what they're paying you, but in reality, we all know that they're not paying 4%. They're only paying less than 1% on the money that you have in savings. But they're using your money. So what happens with that money that you put in there, Diego comes and says, I want to buy a house, and they give him a loan, a mortgage loan of 7%. So they pay you 4%, but they gave him 7% on somebody that bought a house. So this person will sell the house, and they will put back the money into a bank, right? So then what's going to happen, somebody comes and says, Susan comes and says, I'm going to buy a car, and they give him a loan for 8%. Now, here they're making 5%, and you, 3%, 5%, 3%, and you're making 4%. Yeah, so that's 8%. Then the dealer puts the money back into the account. Somebody wants to get a home remodeling loan, and they get a loan of 9%. Again, you're making 4%, and they're making 5% because they're using your money. And the contractors put the money back in their bank. Now I come over there and I say I want to do a debt consolidation loan, and they give me an interest rate of 12%. And the credit cards put the money back into the bank. So what happened here on all of this, from the house they got 3%, for the car they got 4%, from the home remodeling they got 5%, and for the credit cards they got 8%. And we continue to only get 4%. They make 20% of that money, of those loans, but because what they do, they continue moving the money constantly. The banks can make, for any money that you leave there on savings that you're not moving in and doing anything, they can make up to 500% in the money that you leave in. And if you don't believe me, you can go to www.eurofinancial.com, and it shows there that banks make between 400 to 1,300% on money you leave there. So how can we stimulate what the banks are doing with our money? We're getting 4% or less, almost 0%, but they're making money, constantly making money with your money. So this is the way we're gonna be working this thing out. We have the annual target of the spending. It says that for every dollar that we make, we pay about 20 cents for automobiles, 30 cents for housing, and 40 cents for everything else, and maybe 10% for savings. In reality, we know that a lot of people are not able to save anything, so they're spending every dollar that they make in somewhere else. So how do we take control of those 90 cents that we are giving to somebody else? I'm going to give you an example. And this is something that it will be, let's say that I'm the bank, and you have $20,000 in the bank, but you want to buy a car, but you want to get a loan. And the loan is going to be 6% interest. But you think about it and say, well, if I have the cash in the car, I don't want to be paying a 6% interest loan, right? I just can get the money out and pay it and don't pay any loans. But me as a bank, I can tell you that you would be better off paying a 6% loan for 60 months and leave the money on the bank, making 4% annual interest rate. And you're gonna think that I'm crazy, that you're gonna be negative 2%, that you would be better off taking the money out and paying for whatever you wanna buy cash, but that's not the case. So let's say you pay $25,000 at 6% interest rate for 60 months. Your monthly payment would be $483.32, and the future value of the loan would be $28,999. So that means you pay almost $4,000 in interest. Okay, so that is this part over here. That's what you do it. If you leave the money in the bank at 4%, you have $25,000, 4% with 60 months, and the future account value will be $30,525. And the reason is because although you're getting less interest rate, 4%, it is doing a compound interest rate. So every year it's gonna be more, it's gonna be more. The difference here, your future account value is 30,525. You pay for the loan 28,999. You have a savings of, what is that? I think you made a savings of 1,526, leaving your money in the bank at 4% and paying the loan at 6%. If you guys have questions, you can ask those questions in the Q&A, and then we can go over at the end of it. But I hope that this makes sense, how leaving the money 4%, because it's a compound interest, you make actually more money leaving your $25,000 and you're paying less money making the loan for 25. So how can you get 91 cents money back from every car you will ever buy, drive, and own, right? How can we do that? I'm gonna show you the way how it's gonna work. So this is a policy illustration. Remember, I told you we needed to do a life insurance policy, a whole life insurance policy, right? To start accumulating cash. I want you to start thinking about your premiums as a deposit to the bank instead of as a payment or as an expense. Because when you do that click in your mind, you will gladly start putting money into your savings, into your bank, and not into the bank, but somebody else is making money and you're not. Age doesn't matter. A person that is younger, it would be better off. The life insurance would be less costly, and they can actually put more money into cash accumulation. But even a person that is 60, 62, 63, or 64, doesn't matter. They can still apply for a policy, and if they're in good health and they're approved, they would be able to get it. So and then it has a death benefit on it. So let's say, for an example, this is a person that is age 30, and every year he's going to put $10,000 into the premium, into the life insurance. So in year 3, he decides that he's going to buy a car, right? And instead of paying somebody else for this loan, he is going to pay himself back. So let's say he's going to get $25,000 out of his policy, and he's going to pay the car back like a regular monthly payment. So at the end of year 3, he has paid $6,000 at the age of years 4, 5, 6, and 7, he paid off the car. So here you will see that he has put $70,000 on his policy. He paid back $30,000 to the policy. He makes $75,000. So what extra? So what he has, he makes $75,000. What he's telling you here is he put 70, he got a loan for 25, and he still made $5,000 on interest that he is going back to his account. And as you can see here on the cash value available for the account at year 7, he still has $67,881 on cash value. So if you divide the 67,881 by the 75,000, it will give you the 91 cents. So for every dollar that you spend in the car, you can get back 91 cents by using the policy money available to you to buy the loan. So this is an example. Then he decided in year 2, year 8, he decided to buy another car. And he started putting any money on the policy after year 7, which we don't recommend, because if you're using this as your bank, you want to start putting more money so you have more leverage to use more money to do whatever you need to pay or use it for. But he stopped. So now he is only putting back the $6,000 every year to pay the $25,000 back. And in year 12, you can see the cash value is $91,473. His cash value grew $23,592. So he's not losing any cash value. It's still growing, and he's still using the money to buy the things that he needs to buy. So if it did work for a car, it will work for everything else that you have. There's 3 rules that you have to follow. You have to pay yourself first, which in this case is putting money in your bank, which is the policy. You have to pay yourself with interest so that it's still, you're not paying somebody else, you're paying yourself. So if you buy something that you're gonna finance it yourself and you're paying yourself with interest. And then number 3, you will recycle and recapture your money. And that's how the banks do it. They don't keep the money just sitting there. They keep moving it and moving it and moving it so that they can continue to make more money. Again, if it is works for a card, it can work with anything else that you want to finance. Then let's go to how being your own banker actually works. This is an example of a chiropractor that he has his own business, but he had debt. His debt was $478,774. He has Discovery card, a credit card. He has a Lowe's credit card. He has Nostrum credit card. He has a Wells Fargo private loan. He has a BMW. He had a boat. He had a condo. He has a house. I mean, he has a chiropractor business, so he was making money, but he also had all this debt under his belt. And you can see the amount of money that he was paying every month for every debt that he had, and the interest that he was paying, and the payments left that he had over to do to be completely debt free. So the total debt was $478,774. Total payments amount was $5,777. In a year, it was $69,324. A year, that's a lot. That's more money that regular people may have to pay, but he was making money, so but he also was having his fun and creating wealth and doing all of these things, but he had debt. So when he went to a presentation, he asked the person, said, I want to get out of debt and I want to use this. How can you help me? It was going to take him 19 years to actually pay everything that he had, which included the condo and the house. And we know that sometimes you refinance for 15 or 30 years. So, but it will take him 19 years to get out of debt completely. So when they say, what can you do, how much money you can save a year, he came out with a number of $25,000. And they asked him, sir, how can you come out with $25,000? He goes, well, I already put money on my 401k, and anything that comes in my business that is cash, I use it as a saving. So, and I can easily put $25,000 a year. So we're gonna use that number to show you this how he was able to get out of debt in 6.5 years. And we're talking about a big debt, almost $500,000 on debt. So let's see how they did it. So when they said, okay, you're gonna deposit $25,000, the policy immediately within the same amount that he was approved, he was able to get a policy cash loan of $14,863. So when he was able to take that money, they immediately pay this credit card, they pay Lowe's credit card, and they brought down Nostrum, the next Nostrum down to $3,531. So the key here for everybody that wants to do this is that he already had those payments for the other credit cards. He had $448 a month on payments for the other 2 credit cards. And you have to do open a segregated savings account on the bank and start putting that money into that account. You need to start putting monthly payments like you were paying it before. You're not gonna say, oh, I don't have those payments, I'm gonna spend that money. No, you will put it into a segregated savings account. So in year 2, when he deposited his next $25,000 policy, he was able to take cash, 60,571, and he, on his segregated savings account, he had 5,376, which is 448 times 12. So he was able to save 5,376. If you put these two together, the 5,376 and the 16,571, he had cash available for 21,945. Now, immediately what they did is pay Nostrum down, the Wells Fargo down. This is the personal loan, and the BMW payment went actually down. So now you can see that his total debt was 378, and now is and now he's only paying to other people 3,860, and now he's going to be able to put 1970 into his savings account. So now that will be, we're going to be saving 1970 for 12 months for next year. Year 3, he deposited 25,000, and if you pay attention now, the policy cash value loan is 25,541. Now you're able to actually get more money than the policy that you put it in there. More, as a loan, you're getting 25,000, and you only put 541, and you only put 25,000. His segregated savings account now was $23,004, right? His total cash was $48,545, and now again we're gonna go pay these loans down, and the condo is gonna go down as well. Now his debt is $283. Then we go to we're gonna go to year 4, but for a minute right now I'm gonna put this one. This is where the marathon starts going on. When you are able to get more money out than when you are deposited into the policy the first year, that's the compound interest is growing faster now, and that's why you're able to take more money for that year. So here, this is an example how much you put it in 3 years. So year 1, 25, year 2, 25, and year 3, 25, a total of 75,000. The first year loan is 14, the second is 16, and the third year is 25, which now you have a 55,000 loan. If I ask somebody how much is left in your policy, the regular people and the immediately they're gonna tell me it's $20,000. The 75,000 minus 55 is 20,000. But it's not correct. The reality that in your policy you still have $75,000. And the reason is because the loans are coming from the general books from the insurance company. Every $25,000 that you put into the policy is still in your cash accumulation and is getting interest at that amount. So the only reason why they use your $25,000 a year is just to see how much money they're gonna loan you for that year, which is about 60% of the $25,000. This is 60 to 65%. But your cash accumulation continues to be $75,000. They just use the percentage. They just use that money to use the percentage that they're gonna let you borrow. The loans, though, is with the insurance company, and it is at 6%. And if you remember the example that I gave you, they give you the 6% loan, but you're making money here on the $75,000. You're making your guarantee rate of return, and you're making your dividends. So that's why your account continues to grow and making more money for yourself. So now we can go to year 4. In year 4, you have 25,000. You can get out 26,000, and then you have 44,124. Now you have a total cash of 70,428. You're gonna be paying now. The condo is gonna be gone. Hold on this one. The condo will be gone, and then the house will will be reduced as well. And now year 6, then year 6, there is a cash over here. Year 6, he's only going to be able to put $10,000, and the reason is because the IRS has a threshold that says that the policy cannot have, a certain amount of policy cannot have much more money than the threshold that they put in there. Otherwise, they will have to pay taxes on it. So the insurance company is watching really closely when that's going to happen. And so the deposit now is going to be only $10,000. And then he's going to be able to get $13,000 out of that. But now the caveat on here is that you can open your second branch, because we're saying you're your bank. You can open your second branch, which means you can have another policy. You open another policy and you're able to deposit $25,000. He was able to get $14,000. Now, in total cash, he was able to get $82,627, and he paid the house off. He only owed $62,000 now, and he has some money back. Well, he didn't want to stop there. What he did, he started paying those loans that he took. And the reason why he started paying those loans is because if something happened to him while the loans were still active, the death benefit will be a guarantee. So if he had a family and he had a $500,000 death benefit and he had, let's say, $150,000 in loans, the death benefit would be reduced, and so the beneficiaries will get less money. So the insurance company will make the money that they loan him by reducing the death benefit. So that's how he did it. But he wanted to make more money, so he started paying those loans, and then continue to accumulate on the cash value that he had in his account. So 6.5 years that he was debt free, no more debt. And that's how you can actually do it. Once you don't have any debt, you can use money. And this is I'm just showing you how you can get out of debt. But if you want to use the money that you put it in your policy for anything else, for investing, for buying houses, for whatever you want, that's how you can use it. The money is there for you to use as you see fit, but you just have to make sure that you understand how it works, and you can actually get out of debt and then continue to live just a free life. Let's say that, financially free, right? So now, this is the policy extra benefits. It has a death benefit. The policies are exempt from judgments and liens in most states. So what this means is that if somebody tries to sue you personally, this money cannot be touched, because this policy is a contract between you and the insurance company, and that money, nobody can touch it. So that's also how the rich people, save their assets, save their money, right? The internal value grows tax-free. You don't have to pay taxes on that money because you're getting that money as loans, and you're paying it back to the insurance company. Now, the loans never have to be repaid. However, it will, like I explained to you before, it will reduce the death benefits at the end, right? And also, you can use this as a means of retirement income. So if people don't have a 401k or anything like that, they can start building these policies up, and they can use it when they're ready for retirement to get money every year or every month, and they will be as a form of loan. So they would not pay any interest, any taxes on that money either. So there's some benefits to have this as well. Now we can go to questions.
Well, I would have to tell you that was a lot of information.
Yeah.
It definitely is something that a professional as yourself would really need to sit down with somebody, because going at this on your own, you're going to have a lot of questions, right? Trying to find the right person to help you with this, you're going to have a lot of questions. And I can definitely see this as a major benefit because you guys are literally, I mean, you're helping people use tools that are out there, use them correctly, and I got to tell you, it has a very good outcome. You know, it definitely has a very good outcome, and it's a different perspective. What I liked a lot was, I mean, I come from the financial and banking background, and so I know what you showed first on how banks utilize the investment capital, the deposit capital, and how they put it to work. Yeah, I can. So, if you guys didn't know how the banking system, especially at the beginning, banks started with something called fractionalization, then that is how banks started to exponentially grow the power that they have right now to use our money, leverage it, and make money like that. But with that said, Rebecca, I think this was amazing information. And we're going to go into the Q&A. So if you'd like, what I'm going to do is I'm going to have you disengage from your presentation. And we'll go ahead and share your full contact information here. And then we can start the Q&A, because it's always great for people to get to see how they can contact you while you're helping them.
Yeah, and this is, you know, I work for the state of Texas, but you can actually, if you live in another state, you can look for people in your state that can actually, insurance agents that can maybe be able to help you. But if you don't know them, you can call me and then we can work something out. So I can actually get licensed in some other states as well. And every person is different, right? Every person has different needs. So that's why it has to be it's unique for a person, or unique for the person. So I'm sorry, it's very unique.
Absolutely. So let's go ahead and get started here, guys. Here's her full contact information. We have a good amount of questions. If you have questions or something might drum up a question, feel free to put that in the Q&A section. We have Reginald Anderson. He says, in the example of buying a car at 6% versus leaving the money in a savings at 4%, was the car loan calculated at simple interest?
Yes, and this is why the example was is because the insurance company charges 6%, but it's just a simple interest at 6%. It doesn't charge you like it's not a compound interest. So as long as you do it at 6%, that's it. Got it.
Rosa Alvarez asked, which life insurance companies are the ones used, and what are their names?
So I have mutual trust that I use. Actually, F&G has a product that works like that, but it's more like index insurance. But it's an index, but it actually also works the same. But for this, it's more mutual trust that I use, that I like.
Okay, let's go ahead here. Does the insurance company help with the strategy/plan for systematically paying down the external loans?
No, that would be something that you can work out with we can help you with that. Set up like a spreadsheet, and once we know, because so let's say the policy, a percentage is going to go into the life insurance, the death benefit, and then the rest will go into the cash accumulation. Once we know how much is going to go into cash accumulation every year, we can actually say, okay, this is how much you're going to be paying into cash accumulation, this is how much you're going to be able to get out, and this is how we can minimize the expenses.
So basically, using a professional as yourself can draw out that plan. Got it. Somebody here stated, just a comment, I just borrowed $95,000 against my policy at 5% interest to buy real estate. Feels sweet. This is a powerful wealth building, and my real estate deal. This is powerful wealth building. My real estate deal will generate over 30% returns, which is great leverage.
So that's great leverage. You're using that at 5%, and then you're going to be making more money. Just that is the beauty of it. That's how rich people do it.
Yeah. That's how they do it. That was Mr. Rick Bressler that asked that question here.
Yeah, right. Oh.
Yeah. So Jose Rivas asks, what is the limit on amounts borrowed?
Okay, so they're different. The companies are different. So, but most of them up to, once you have the cash accumulation, it's up to 90%. Once we know what the difference is, that's what we say 60%, because we don't know on these examples, we don't know each person how much they're gonna qualify for the life insurance, because it all depends on the age and the health. You know how much money they have to pay for the health, you know, for the benefit, for the death benefit. And then whatever is left will be the cash accumulation. So, but once you know that, you can actually borrow up to 90%.
All right. Is there a way one can do this through a foreign-owned LLC? How would the tax laws work in this case, if so?
If he's gonna do it through the company, it can be done through companies.
Okay.
The loan will be, the policy will be through the company, and that's how the banks do other do policies as well. They take policies. Businesses can actually take policies for the key person or key employees as well.
They ask you through a foreign-owned LLC, so does it have to be?
Oh, foreign-owned? No, it has to be here. It has to have a legal entity in the United States. I'm sorry.
Got it. Here they ask segregated savings account, question mark. Is that with life?
Yeah,
insurance?
when we say segregated savings account is you open another account that you're not gonna touch, that you're just gonna be putting the money that you were paying, the monthly payments that you were doing every month, so that you don't touch that money and you act like you don't have it. And at the end of the year, when you pay your other policy, then you get that money and accumulate more cash to be able to get out of that sooner.
Makes sense. Same person asked, I'm a new agent and I would like to learn more about this. So what's the best way for them to get a hold of you? Through the phone, through the email, or?
They can send an email to email. That would be better.
And got a question
Or
for
they
you.
can text.
Got a question. It says, is it
Vigilante.
Yeah, Vigilante.
Yeah.
Okay, so it's vigilantefinancialservices.com.
Yeah, the email is correct.
Okay, the email is correct. All right.
Yes,
Okay. Somebody asked, is there a minimum amount of money required to start a policy such as this?
it is up to, that's what we say, it's up to the person, how much money they can afford, and what they get qualified. It's not really a minimum, but if you wanted to really start creating cash and accumulation, it's as much as you can put in there, because it's gonna be like your savings account, right? How much you can save so that it accumulates faster. But there is not really a minimum. I mean, I have people that have $400 a month into it, and they can pay monthly, they can pay quarterly, they can pay semi-annually, or all the amount annually as well. So it's not like you have to put the whole amount of money right away.
Okay. So the next question here is, how long will it take to grow cash value to borrow from the cash value?
I'm sorry?
How long will it take to grow cash value to be able to borrow from the cash value?
Okay, so this is where the payment method will be very important. So if you pay monthly and you're paying $400 a month, it will take you probably a year to be able to borrow a good amount of money, right? A good percentage of money from that one. If you pay annually, within 30 days, you can get the money. You can get the loan right away.
Wow, okay, good. That was a great question there. Rosa Alvarez, does the cash accumulation depend on the stock market?
No, it does not.
Okay, go a little bit more deep into that. Can you tell us, Rebecca, why there would be a difference there, or?
The insurance company is not using the market, the stock. They use the indexes to see to pay a guaranteed percentage. Let's say that, but it's not the losses. It doesn't affect you. They have a different way that they invest the money. But no, they don't.
Correct, and that was what I was looking for. The losses don't affect you, which makes it a massive benefit there.
Yeah,
That
so
is
remember, there's going to be a guarantee loan interest that they guarantee interest that they're giving you every year. The only thing that is going to vary will be the dividends that they make every year. In 1 year maybe 1%, 1 year maybe 10 or something, depending on how well the company did that year, right? So
correct.
that's
Okay, guys. And Ms. Carolyn Sanchez, the email rramirez@vigilantefinancialservices.com is the correct email.
But they can text me as well at the 713-492-4951 if they want
Okay,
to
great.
text.
That's good. That's very good. And the last question here is, I think they were asking if it matters if it's whole life versus life insurance versus term life insurance.
Okay, say that again. I'm sorry.
It says, I think they were asking it if it matters if it's whole life versus term life insurance. I'm not quite sure what Carolyn's saying.
Okay, so term life is just, it doesn't accumulate cash. There's some that they're accumulating cash now, but it does not do, it's just for that one, it would be the death benefit. That's it. It's not designed for this. This has to be a whole life insurance. And again, it's not your regular whole life insurance. It has to be specific for being your own banker, which it will be with the mutual company.
Okay. And
so with the term, once you reach the term, that's done. You don't get anything back, basically.
Perfect. Makes total sense. Well, guys, this has been great information. If you want to go ahead and reach Rebecca, I mean, she said go ahead and you can call her, send her a text message. The email is correct, and we do apologize. It's vigilantefinancialservices.com. Any comments that you want to make to close us out here before we move on?
Just if you want more information, because everybody's personal, just send me the text, send me an email, and I will reach to you. And you can, the thing that I want everybody to think is, and take away with, is this is your bank, this is your savings, this is your life. You can take control of the finances that way. It's time for us to stop paying somebody else to, finance our stuff, and then they get rich out of our money. We can do the same. Excellent. We have the tools to do it. So now let's take advantage of it. One thing is, are you robbing yourself? Are you robbing your children or your grandchildren? Right? Because that is something. Somebody told me, don't tell that to my kids. I said,
very good point.
That's a good point, right?
Very good point. And if you look at it that way, guys, it doesn't hurt a simple phone call and text to get a hold of Rebecca. And so, Rebecca, I really want to thank you for being a part of the SVI family and also sharing your company, your experience, and everything that you do to help a lot of our members.
I do want to thank you, Diego, for having me and trusting me with this. I really appreciate it. And I hope I can hear from a lot of people and I can help a lot of people.
Absolutely.
Thank you.
And we want to thank our some of our affiliate partners and vendors that work with us at SVI. We're always super proud to have them there. For those of you that are SVI members, we're going to be putting Rebecca's company into the network vendors directory. So you guys will be able to contact her and get to know her a little bit better. For also the people that are new to StratiVentures, we'd love to have one-on-ones with you. So simply go to our company webpage, StratiVentures.com. If you go to Team SVI, you'll see a picture of everybody there at SVI, and under my picture, you can actually click my calendar and just get yourself onto a one-on-one, and we can get to know each other. And ask us about our basics. For those of you that are looking to get into real estate for the first time at a very, very comfortable manner, let us know. We'd be happy to work with you with the basics. Another thing is, thank you everybody for attending. You can like and subscribe on all the social media platforms. And there's our phone number, our email, and our webpage for everybody to get to know us. I think we've got one more question that just popped up here. Is whole and UIL the same? IUL the same? I'm not sure.
No, that's index universal life. And that's what I was saying. There's something, F&G has an index universal life that actually can be used to do the same thing as a whole life. but not all whole life and universal life insurance are the same.
Perfect, perfect. Rebecca, thank you so much. Have a great evening, everybody that joined us. I think this is, if I'm not mistaken, Oriana, this is the last one that we have for the year, and we are ramping up the 2023 schedules, and then just simply go to StratiVentures.com, go to the events page, and you're going to be able to see everything that we've got coming here pretty soon. We'll load all that stuff on there. So have a great evening, everybody.
Thank you.
All right, good to see you, Rebecca.
Bye-bye. See you later.
Yes, ma'am.